Hello, everyone. Welcome to today's webinar. My name's Stephen Reiter. I'm responsible for the options business at AvaTrade. The platform we're using today is the AvaOptions web trader, which we just launched a few months ago, proving to be very popular, easy to use. I hope you'll like it. Today, we're going to be talking about options trading, how to use options to express your views and to hedge. So basically how to trade with options, and specifically how to trade with options with our trading platform, using our trading platform. I'm going to assume that you have some knowledge about options, but I will, of course, give full explanations along the way. I just won't be talking about options theory or some more details about options pricing. Just going to wait another couple of minutes for more people to join us. We'll start, well, basically in a few seconds, at 3 minutes past the hour. Let's get started. All right, let's see who's joined us. Okay, welcome everyone. We've got, well, we already have about 90 people who have signed in, which is terrific. So welcome everyone. Welcome Elijah, George, Kevin, Laura, Linda, Matthew, Mohammed, Neil, Sherilyn. I won't read everybody's name. Okay, so let's get started. I'm going to log in to the trading platform here. There are two ways to log into the trading platform. The best way is to log into the AvaTrade website. And when you go to your account listings, click on web trading. Alternatively, you can just go straight to www.avaoptions.com and enter your account number, which is going to start with a 5 or with an 8. 5 will be a demo account, starting with an 8 would be a real account, and log in with your password. You can do the same in the mobile apps. We have both iOS or Apple and Android versions. Same look and feel as you'll see here in the web trader. You can log in either with your account number or with your email and password. I'm going to click here to log in. And we're going to come into a nice fresh account that we can use piece by piece, step by step, to show you how to trade. So our trading platform looks like many other trading platforms. On the left side, you have assets. You can click this orange button and choose a category of assets. For example, indices, you'll get a list of equity indices. You can highlight which ones you would like to have in your account as a favorite, and it'll be added automatically to your favorites. So if I go over here and choose favorites, you can see the two that I just highlighted. Let's just stay on all since we have plenty of screen real estate. So we've got bid and ask for the different assets that we trade. You can scroll down, there are about 45 different assets. And in the center of the screen, we have a chart. This is a chart for Aussie dollar. Let's pick the most common asset people trade, which is euro dollar. This is showing us a candle chart with 1 minute candles, open, high, low, close, shown in the candles. You can also choose different types of candles, like a Heikin Ashi, which is very pretty. You can choose different candle sizes, like a 15-minute candle, which means you'll have more history down along the bottom. And you have buttons here to zoom in, zoom out. You can also pan right and left and up and down. And if you just hit this focus button, everything comes back to the current market price. So here you're seeing, like many other trading platforms, a history of where euro dollar has been from 5th of March until now. The unique feature on our page is on the right side, where you have profit and loss diagram. If we are to buy 100,000 euro dollar and the market goes up, we're going to have profits. If the market goes down, we'll have losses. We can see those profits in price terms, the same terms as the asset itself is quoted. For example, here you can see in the middle, this is like 38 pips. But we click here in price, we can see our P&L in dollars. This is a dollar account, or we can see it in euros. So you can see exactly how much money you're risking. If you have a larger trade size, you'll have more profit and more loss, clearly. Let's put it back to 100,000 here. If you So if you go long, if you buy, market goes up, you profit, market goes down, you'll lose. If you go short, then you'll profit when the market goes down and lose if the market goes higher. If I click the word limit on the right side of the page, I can put in entry and closing limits. So for example, I can click here on the open arc and I can say, I want to buy at 118.50. I can double click and put in an exact number. I want to buy at 118.50, good until the end of today. The end of today meaning 5 p.m. New York time. Someone is saying that they cannot hear. Two people say they cannot hear. Others say they can hear. Would anyone like to just chime in saying they can hear? I'm sure you can, otherwise more would be complaining that they can't. So I apologize for those of you who say you cannot hear. Stephen says you can hear. Yep. Okay, great. Everybody can hear now. Thanks very much. Okay, so back to the screen. I put in an order here saying that I want to buy at 118.50, or I've set up an order. I want to buy at 118.50, and I'll put in a take profit here at, let's say, 119. So I want to buy at 118.50, and if I get into the trade, if that's executed, I'll put in a take profit at 119. That's called a conditional take profit because the trade hasn't been executed yet. You can see this P&L diagram is very clear. Once the trade is executed, if the market goes down below 118.50, you'll start to lose money. If it is executed and moves back higher and reaches the take profit, you'll be out of the trade at 119. That's why you have this gray area above. And we can, of course, put in a stop loss as well. Let's put in a stop loss down below at 118. And very simply, I want to buy at 118.50. I'm going to put in a take profit at which I'll make $500 profit. And I'll put in a stop loss where I'll lose $500. The stop loss is not guaranteed, which is normal. If I were to go short instead, it looks like that. I'm going to make money when the market goes down with a take profit down below and a stop loss above. So I'm going to execute this trade just so you can see it. I click buy again. It's showing us that we're going to buy at 118.50 as a limit order, buy limit 118.50 with a conditional take profit and stop loss. I have $100,000 available in this account. This trade, if executed, would require 1% margin in this account, which is $1,100 because of where euro is trading. This is, what kind of account is this? This is should be 1% margin, yeah. And the bid offer spread is bouncing around, it's very small. Let's click execute. It doesn't require any margin because it's just a limit order. So just down on the bottom now, you'll see our open positions are in blue. It says we have a limit order to buy euro dollar at 118.50 with a contingent take profit and stop loss. They're all in blue because they're all cold. They're all unexecuted at this point. So that's what a limit order looks like. I'll close that. Now let's look at something else, which is options. The issue with trading spot like this, just buying the FX, is that other than a limit order, you really only have two things going on here. You're buying, if the market goes up, you can have profits. If it goes down, you have losses. You have no way to qualify the trade other than take profit and stop loss. And the problem with the take profit and stop loss is if you're bullish and you think the market's going to go higher and you put in a stop loss just in case the market goes lower like that, once you hit the stop loss, you're out of the trade. So you don't have much room to express your view. Your view is just binary, buy or sell. There's no qualification, there's no asymmetry to it. It's symmetric risk up and down. So if you buy with a stop loss and you hit the stop loss, you're now out of the trade, as opposed to an option where you can buy the right to buy euro dollar at 118. And if you do, if you buy the right to buy at 118, then or 118.50 or any other level, you own this right. You can go to sleep, you can go on vacation, you can do whatever you like, and wait until the end of the option period, which can be a day or a week or a year. And if you're right, you'll have profits. And if you're wrong, the most you can lose is what you paid for the option. Let's see what that looks like. So now instead of trading spot, let's trade an option. I click the word spot, and I'm going to choose my strategy. That's the strategy button. I can trade a call, a put, or I can trade option strategies like strangles and straddles and risk reversals and call spreads and put spreads. So let's choose a call so we can see what a call option looks like. And once I choose a call, a new element is added to the screen in the center, these parabolic arcs, which are in different shades of gray. We've chosen here, the default is a 1-week option. This is a call option. You see the expiration date up here, 7 days, 15th of March, which is 7 days or a week. I can choose any day I want as long as my trade size is at least 100,000 for currencies. I can make my option longer or shorter, but let's just leave it at 1 week. In this center, we have what are called the confidence intervals. The inside gray arcs are showing us where the market might go in the next week based on plus and minus 1 standard deviation of movement. The standard deviation is a statistical measure that's based on the implied volatility of the option, basically saying that we can be 68% confident that the market is going to be between this lower gray level and the higher gray level. We're framing the risk of the market. The second arc with the 2 white dots around them, these are the plus and minus 2 standard deviation range, which covers a 95% confidence interval. We can say we're 95% confident that the market is going to be between these 2 dots in 1 week. And before 1 week, we're going to be along the arc. And then the outer darker gray is 3 standard deviations, and we can say that we're 99.7% confident that the market is going to be within that range. I'm just going to shrink it down a little bit. So we're 99% confident that we're going to be between, looks like around 114.40 and 123.30 in a week. It's a pretty big range. So let's put this back again. You hit that focus button, it'll bring us back to our starting point. So what else is different on the screen is the profit and loss diagram now is asymmetric. We're looking at buying a call option. When you buy a call option, you pay for it up front. The most you can lose is what you pay for the option. That's why the red is fixed at a loss of $515, whereas the green is showing unlimited profit potential. What's happening? We're buying a call option, which means we have the right to buy at the strike price, which is currently 118.80. I have the right to buy at 118.80. I have the right to buy 100,000 euros against the dollar at 118.80. That's going to cost me $513, or as you can see in the orange button, that's 51 pips, 0.0051 times 100,000 is $510, $511. And that's the most that I can lose. As the market goes higher, I have the right to buy at 118.80. And if it goes up to 120, I can sell at 120, I have 120 pip profit. That's $1,200 minus what I paid for the option, which was the $500. So you can see your profit and loss very clearly. If I put in here a limit order saying I want to take profit, I want to sell the option at 200 pips, 0.02. That's going to happen up here. If it's at expiration, we can see that the market needs to be for the option to be worth 200 pips, the market has to be 200 pips higher than 118.80, which means the market's going to be at 120.80. I just skipped a whole bunch of steps, so I'll come back to that in a minute. Let me put this horizon line back here. The orange line, let's just close this limit order. The orange, so the red and green is showing you the profit and loss of the option at expiration. The orange line is showing you the profit and loss today. When you buy an option today, you're only going to lose or suffer the bid-ask spread. You're not really losing anything if you buy an option today. And as the market moves higher, you're going to start to profit. And as the market moves lower, you're going to lose money, but not all the way down to the level of expiration. Over time, as time value decays, the option will reach the red and the green. What do I mean by that? Take this horizon line. Today is now, right? The orange line is showing us our profit and loss profile today. If I go through time, after 5 days, the option is worth less. After a week, it's worth less. The option at the expiration is worth either 0, which means you're going to lose all that you paid for it, or it's going to be in the money, which means you're going to get the intrinsic value of the option. Intrinsic value being where is the market at expiration minus the strike price. So if we're trading at expiration at, let's say, 120, that would happen when spot is at 120. Spot's at 120 and the option strike is 118.80. You have the right to buy at 118.80. You sell into the market at 120. That gives you a profit of 120 pips. Sorry, that means the option value is 120 pips. So your profit is going to be 120 pips minus what you paid for it, which was 50 pips. That's why you see this white box showing a profit of $700. So options give you asymmetric profile, asymmetric trading risk. So rather than having unlimited loss potential with trading spot, we can have limited loss potential with trading an option. If I choose a put gives you the right to sell. So now again, you see unlimited profit potential as the market goes down because we have the right to sell at the strike price. And the most we can lose is what we paid for the option. Now, what can I work on here? What can I play with? I can change the strike of the option. If I have the right to sell at a lower price, it's worth less money. It costs less. The right to sell at 119 is more valuable than the right to sell at 118, clearly. Right? I'd rather sell at 119, so it must cost more. 118, the 118 put costs 25 pips, 0.0025, whereas the 119 put costs 65 pips. The other thing that I can work with here is the expiration date. A longer option is going to cost more than a shorter option. A 1 month option is worth more than a 1 week option. Just like insurance on your car, insurance on travel, insurance on anything else. Insurance for a month costs more than insurance for a week. Options are essentially an insurance product. The beauty of options is that you can be the buyer of the insurance or you can be the seller of the insurance, which I'll show you in a moment. So if we take a 1 month option, a 1 month option costs 91 pips. The 1 week option was 50 pips. So a 1 month option is less than double the price of the 1 week, but it's roughly double the price of the 1 week. A 4 week option should cost roughly double a 1 week option. The relationship between time and the price of the option is the square root of time. If I quadruple time, quadruple the expiration date of the option, then the option price should double. That's probably for an advanced class. So again, we have framed the risk of the option with these arcs. If I make it the option longer, you'll see that the market can go further, and therefore the range of the market for this is now a 6 month option. The range of the market is showing for 2 standard deviations from 109 all the way up to 129. Whereas a 1 week option, the range for 2 standard deviations is from 116 up to 121. So the longer the option, the more the market can move, and therefore the more the option costs. So we've shown you buying and selling calls and puts. Let's execute a trade. Let's buy a call that's at the money for a month. The market's trading at 118.75. I'm going to buy a 118.75 call on 100,000. I click buy. It does not require any margin because I'm buying the option. The most I can lose is the cost of the option. So I pay for the option, I own it, click execute, it's done. And there you see it in the positions, right at the top of the open positions. I bought a call on 100,000. The strike is 118.75 actually. That's something that needs to be fixed. It needs to be 4 decimal places. We're missing a decimal place. That's about to be fixed. But if I choose that option, I'm going to close this. If I choose it, you can see it pops into this, it shows back up in the trading screen, and you have details of the position on the right. It's a 118.75 call. You can see all the details like the expiration date, the settle date was when I traded it, the where was the market when we opened it? Where's the market now? What's the implied vol? How much did it cost? What's it worth? And what's the profit and loss? So you can get all the details of the trade just by choosing it down at the bottom. So that's buying a call. And let's also buy a put. Buying a put gives you the right to sell. Let's buy a put at 118 in the same amount. Same story. I don't need any margin to do this trade. I'm buying the option. It's going to come out of my cash balance. And you'll see that my cash balance is going to drop. The first option that we bought cost, how much? This is also needs to be showing us more. First option that we bought cost us $250. Sorry, the call cost us $1,000, and now the put that we just bought costs $250. So we've spent some money. It comes out of our cash balance, but it doesn't come out of our equity. We're only losing the bid-ask spread. So you can see the P&L right now is showing a loss of about $120 or $130. That's the bid-ask spread on these two options. But click here in the open positions under Risk Manager. I can see what my net risk is, and you can see all the details. You can see that our cash balance has dropped by $1,250 from 100,000. It's now 98,750 because we bought two options. We paid $1,250 for them. It comes out of our cash balance, but they have value. They're worth $1,100. And that's why we have an unrealized P&L, but the account value hasn't really dropped by much. It's only dropped by the bid-ask spread. You can see our risk. We've done two trades. We bought a call and we bought a put, but because they offset each other, you're buying a call and you're buying a put, you have almost no risk. Go scroll down a little bit further. I can't scroll down, I have to go here. We can see it down on the bottom, sorry. You see our net risk in Eurodollar. We have 3 positions. One of them was a limit order, and we have 1 call and 1 put. Our net delta, our net exposure is long 24,000 Eurodollar. Why is that? Because we've bought a call that was at the money that has a net delta of 51,000. We're long 51,000 equivalent of the underlying asset, and the put we're only short 27,000 because we bought an out of the money put. So our net risk is long about 24,000 Eurodollar. What do I mean by that? Let's choose both of these positions. I'm going to choose the put, and now you see it showing in our screen. I'm going to make this a little smaller. Actually, let's just close this. That's the put that we own. We bought a put, and now I'm going to choose the call as well. We bought a put and we bought a call. Now we're seeing both of them on the screen. And you can see that the put that we bought was the put that we bought expires in a week at March 15th. So the put is expiring right here in 7 days. You can see that right here. We bought a 7-day put and we bought a 1-month call. So you see they're on the, they're showing in the confidence range in the future history, in the future range. On the left, we have where we've been. On the right, we have where we're headed. The call has a longer expiration date than the put. That's the trade that we put on. But each of them has net risk. The call is pretty close to at the money. The put is out of the money. We're going to make money if the market goes up. We're going to make money if the market goes down. But if the market doesn't go anywhere, these options could both expire worthless, and we're just going to lose money. So as time goes by, you can see how the portfolio performs. All of this is adjustable. You can change what you want to see and play around with it very nicely. Let's unselect these. We're back now at our opening screen. Let's look at selling an option. We already showed you how to buy a call and buy a put. Suppose your view is that the market's not going to go higher. You're willing to take the view the market is not going to go higher. How much risk do you want to take? You're not confident it's going to stay around here, but you're very confident that in the next month, let's go for a month, You're confident that in the next month, the market's not going to finish or not going to be higher than 120. So you're willing to sell a call at 120. Today we're trading at 118.75. It's 125 pips away. So you're saying, I'm willing to sell a call at 120. How much can I earn? I can earn 42 pips for that, which is $420 on 100,000. Let's execute this trade. Sell, execute. Now that we're selling an option, margin is required. Not much. You need $365 worth of margin, but because you're putting on a trade now that has unlimited loss potential, margin is required. We're going to look at the entire portfolio and figure out how much risk you've got and use our risk-based margining calculations to charge that amount. So what have we got now? We're long a call, we're long a put, and we're short a call. Let's just look at our calls. We bought a call at 118.80, and now we've sold a call at 120. Put them together, you've got a call spread. Call spread is showing us that we have limited downside and limited upside. We bought a call and we've sold a call. This is called a call spread. This is a low risk, low cost trade and a great way to take a view on the market, a limited risk view on the market. It's also commonly called a collar when you look at it just this way, but it's basically a call spread. You're exposed to the market, but with limited risk on both sides. As time goes by, you see the orange line approaches the expiration, and there you have what your exposure is going to look like. Okay. That is a call spread. And if we want, we can close it. This is because they're both open on this screen. We've highlighted these two trades. These trades are set up for closing. I can say I want to close, let's close half of them. I'm going to close 50,000. I'm going to realize a $69 loss on that trade. The full loss is 136, but we're only going to close half of it. Click execute. And that's done. And now you see that the open position has dropped to 50,000 of each. If I choose all three trades, I can see what they look like together. This is what our net risk looks like. We've got three positions, and you can see that we can have a small profit if the market moves higher. We can have some losses if the market stays where it is, but the dominant position here is going to be that long put because it's larger at 100,000 and because it's not hedged by the other two. So this is what a portfolio of options trades looks like. And you can mix and match long and short calls and puts to your heart's desire, different expiration dates, different strikes, in order to build up a portfolio that matches your view. That's what options trading is all about. Let's look at our risk manager. You can see we still only have Eurodollar positions. Our net delta, that's the slope of the line, the orange line today, is minus 17,000. It means that our current position is going to profit a little bit as the market moves lower because that orange line is negatively sloped. And as the market moves lower and lower, our delta is going to approach 100,000, which is the delta of that put because that dominates the trades. So our positions are all from options. Nothing is coming from a cash trade. We're short 17,000 equivalent. Our Vega means we're long volatility. We're net, we bought options. As implied volatilities move higher, we're going to make money. Our unrealized P&L, just from the bid-ask spreads, is $126. That's options trading. Now let's move on to something else. I'm gonna go back and look at our open positions and clear everything. Let's look at some strategies. Rather than building them up one by one, let's look at some strategies. For example, a strangle. A strangle is a combination of two trades. If you don't know what an option is, what a strategy is, if you want to learn more, just click the guide. The guide shows you then that we're in blue, the guide is active. If I click strangle, I get an explanation of a strangle. What is a strangle? You're selling a call and a put at different strikes. Why? Because you're expecting the market to be range bound. You think the market's not going to go very far, and you want to profit from a quiet market. Again, a great thing that you can do with options that you cannot do trading the underlying markets just with spot, just by buying and selling FX or whatever the underlying asset is. You're taking a view that the market is going to be range bound. You're willing to take the risk that the market won't be range bound. You're going to get paid for taking that risk. You're the insurance company. I click try it. Let's set our range. Let's say for the next week, I think the market's going to stay between 118 and 119. Oh, sorry, between 118 and 120. I think the market's going to stay between 118 and 120. I'm going to get paid $250 or 25 pips for taking that risk. If the market moves higher, at expiration, my break even is going to be the high strike plus the premium that I earned, which means my break even is going to be at 120.25. Right here, this kind of zero line will be 120.25. You can see it here, 120.25. And on the downside, my break even is going to be the low strike, 118 minus the 25 pips that I've earned. So my break even will be 117.75. So you've got a 250 pip range, or a 2.5 point range of profitability in 1 week. You can see, however, that the market was outside of that range not too long ago. Right? We were higher than 120 just on the 4th of March. Just a few days ago, we were higher than 120. So you're taking a bet here. You're taking a view that the market's going to be range bound. If you want to go a little bit longer, let's say you look at a 2-month range, you could set your strikes to encompass the full range that we've seen in the market. If you think we're going to stay within the range that we've seen for the past 2 months, you can do a strangle with strikes at 118.50 on the downside and 122.50, sorry, 122.25 on the upside. And you can get paid for 2 months, 125 pips for that. And your break even is going to be well above or well outside that range. You're not going to lose money unless the market finishes below the low strike minus 125 pips, which means 117.25. So that's options trading strategies. You can build them piece by piece. You can play with it here in the trading platform and see what your risk profile is going to look like as you buy and sell, as the market moves, as time goes by. You can see how everything works together. I am watching for questions. Someone's asking, how do I get an Ava option account? Visit the AvaTrade website, go to the Ava options page. So click on trading platforms and go to the Ava options page and click to open an account. You can open a demo account or a real account. And make sure if you open a real account and you're given the choice of which account you want to use, do not choose MT4 or MT5, choose Ava options. If you're already an Ava customer and you already have submitted your documents and you're already verified, adding an account is straightforward. You don't need to submit any additional documents. Once you're a validated, verified, accepted customer, you are ready to trade options as well. When will equity options be available? We are working very hard right now on getting options on the S&P 500 and options on the NASDAQ live. We expect them to be live in the next month. Then we'll add other global equity indices, and individual equity options will come later this year if everything's working well. But for the moment, we're going to focus on FX and on equity index options, which should basically give you most of what you're looking for. So here's buying a strangle, here's selling a strangle. You can do either one. You can change the expiration dates again. Okay. Options can also be set. If you do an individual option, you can put limit orders on an option. Let's try a call option. Let's say I want to buy this call option, but I don't want to pay 100 pips. I only want to pay 80 pips for it. I click limit order. I go down here and I go to 80 pips, or I just double click, whoops, double click, and I put in 80 pips. it's showing me that I should get filled on an 80 pip buy limit order at approximately today when spot drops to about 118.30. Today's spot trading at 118.70. This is an at the money option. Its delta is 52%. You see right here in the blue text, the D equals 52. That means the delta is 52%. The implied volatility V is 6.71%. So today this option costs 100 pips. If you want to buy it for 20 pips cheaper, the market's going to have to be about 40 pips lower, because the change of the option price moves half as much as the underlying asset, because the delta is 50%. So if we're trading today at 118.75, you want to buy it 20 pips cheaper, spot needs to be 40 pips lower. And you can see that right here in that in the crosshair, that spot needs to be 40 pips lower, around 118.35, in order for this option to be filled. Now, as time goes by, the value of the option, the time value option, is going to be lower. And you can see that that order level is going to change as time goes by. We got a few things going on the screen at once, so it's a little harder to see. But you can play with that right here. I can put my option, I can put in my order again at 80 pips. I want to buy this option at 80 pips. I can buy it at any price I like. I can also put in instead of an entry limit, I could put an entry stop. You can't have both. For the entry, it's either an entry limit or an entry stop. There's an entry limit order with a contingent take profit and a contingent stop loss. So you see the orange line, it's showing us where the market has to be in order to hit this take profit, where the market has to be today to hit this stop loss, and where the market has to be today in order to reach that entry limit order, these three dotted lines. As time goes by, all of those reference levels on the y-axis are going to change because time is passing and the option valuation is going to be different. This is, again, something you can work with. We have videos about this. The mobile app works exactly the same way. Someone's asking, how do I activate those lines? You have that over here on the right side. Click the word limit and then choose what you want to enter. If it's a take profit or a stop loss or an entry, click here on the line, set the levels, set the level. That's how you enter an order. Now I click buy. I'm going to buy a 118.75 call at the limit price of 0.0027 or 27 pips with a take profit, if it's filled, at 265 pips, execute. And you'll see this right there in the bottom. There's the order in blue. I'm buying a call at 118.80, or it's actually 118.75. Unfortunately, you don't see it. And in a moment, the limit orders are going to show as well. They just didn't show up right away, but they'll show in a moment, the limit orders as well. So that's how that works, limit orders on options. If you want to cancel an order, just choose it. This is the order that we had. This was a spot order that we put in at the beginning of our discussion. I click it, it says request is to cancel. I click execute, and it will get canceled, and it will disappear from our open positions. There you see it is. It's gone. History shows us everything that we've done today. Closed trade shows us that we closed 2 trades earlier. Remember, we opened 100,000 and we closed 50. So everything is shown here. Risk Manager shows us all of our net risk. We can trade also indices like the US 30, that's the Dow 30, the US 30. You can trade various indices, but there are no options yet available on them, but you can trade them as CFDs. Now I'm going to actually wind down a little bit right now because, okay, Cindy, you're all set now. I'm going to wind down the presentation because I try to keep these to 40 or 45 minutes, so I want to make sure that I can answer some of your calls. Someone is asking, Eurodollar, is it long buy or short buy? You have a choice. You can buy or sell spot. You can buy or sell the right to buy or sell, which means you can buy or sell calls and you can buy or sell puts. You have 6 different instruments that you can trade here. Let's look at cable or which is the pound against the dollar. We have no positions here. We've got various choices. We can buy or sell the underlying asset. We can buy or sell calls. Right? Sell a call, buy a call. We can buy or sell puts, and we can do various combinations. For example, a butterfly for a month. A butterfly is 4 options. You're going to buy an at the money or buy a call and a put at 1 strike, and you're going to sell a call above and a put below. So this is a limited risk, limited upside, limited downside. It's called a butterfly because if you turn the screen on the side, it kind of looks a little bit like a bird or a butterfly. That's a butterfly. You do this trade if you don't know where the market's going to go, but you're sure it's going to have a big move one way or the other. So you buy this. It's cheaper than simply buying the straddle. This butterfly costs 248 pips. If I just do the same thing with a straddle, it'll cost 287 pips. It costs more because you have unlimited upside and unlimited downside. You can even go with 4 strikes, something called an iron condor. The iron condor has 4 strikes because you're buying a strangle, you're buying a call and buying a put, and you're selling a call and selling a put further out, or of course you can do it the other way. You can move any of these strikes, mix and match, and do whatever funky strategy suits your view. What's neat, again, is that you can see it all on the screen. You can combine, mix and match different dates and see how your portfolio is going to operate. One last thing I want to show you. Let's say we buy a call. No, let's say we buy cash. We're going to buy the pound in 200,000. I'm going to buy 200,000 pounds against the dollar. There's my exposure. I click buy and execute. Trade is done. There it is in our open positions. I bought 200,000 pounds. My risk is now 200,000 pounds. That's what I bought. It's in cash. I have a risk of 200,000 pounds. You see down on the bottom. In Eurodollar, I'm fairly flat, and it's all coming from options. If I look at it in terms of P&L, if I click and choose this option, very simply, I have unlimited upside and unlimited downside. Look at my P&L in dollar amount. Suppose I've changed my view, and I'm now concerned that the market's going to drop, and I want to protect myself. I'm still bullish, but I want to buy some protection. So what are we going to do? We're going to buy a put. We're going to buy a put. So I'm going to go here, and I'm going to, instead of choosing this, I'm going to add a put option. Put on 200,000. I'm going to buy a put for a week. No, let's do it for a day. You can trade options for any day, 1 day, 2 day, 1 week, 2 week, 1 month, 3 month. I'm going to buy a put at 138. It's going to cost me 18 pips. I click execute. That's done. Now I have 2 positions in the pound. We bought spot, we bought cash, 200,000, and we bought a put. Let's put them together and see what they look like. That's the underlying position that we did in my P&L, and now let's add in the put. The put is protecting my bottom line. I bought a put for a day. Now I can see I've converted my position. I'm still long. I'm still going to win if the market goes higher, but I protected it by buying a put. That's called a protective put. And what does it look like? It looks just like a call, because a call minus a put, the combination of a call and a put, is a forward. We have a strategy called synthetic forward. Last thing I'll show you, let's look at dollar yen, for example. We have something called synthetic forward. In a synthetic forward, you buy a call and you sell a put at the same strike. You see this cute little handler here. I'm buying a call and selling a put. It's the same thing as buying dollar yen in the future. Why is that? Because I bought a call. If the market moves higher, I'm going to exercise the call. If the market goes lower, then the person I sold the put to is going to exercise his put. So either way, in the future, you're going to be long. It's called a synthetic forward. Buying a call and selling a put is a forward. Call minus put is a forward. So combinations of calls and puts can be used to do everything. Will you be FSA regulated in the UK? The answer is we are already able to offer options trading in the UK. With Brexit, AvaTrade opened a, I think it's called a provisional FSA application. And because Ava was already regulated in the EU through the Central Bank of Ireland, Ava is also already regulated in the EU. And Passport, of course, to all of Europe, also regulated everywhere in the world, or all the major countries, not regulated in the US and New Zealand, I think are the only two major places where you won't be able to trade with us under regulation. If you are in a country that doesn't offer good regulation, then you'll be trading with the Ava parent company, which is in the BVI, so you'll still have regulation. You'll be trading with a regulated entity. One other advantage of options trading in the EU is that we can offer 100 times leverage. Options are specifically excluded from the ESMA limits, from the ESMA leverage limits. If you trade cash or FX in the EU, you're even in this platform, your leverage is going to be limited to 30-1 or 3.3% margin. If you trade an option, you'll have 100 times leverage, 1% margin. If you mix spot and options, then you'll have that lower leverage. Synthetic forward is available in Canada, Cindy. We do offer options trading in Canada, and it is, again, a strategy. It's a very simple strategy of a vanilla call and a vanilla put. However, in Canada, you don't get that leverage advantage. In Canada, you don't get the leverage advantage. In the EU, you do get the leverage advantage. In Australia, you also get the leverage advantage. We can offer 100 times leverage for options trading. Any more questions? This presentation is being recorded. It will be in the Ava options playlist on YouTube tomorrow, I believe, and you'll be able to watch it again. Feel free to click that chat button right here, chat with us to ask questions, and one of us will be able to help you, I hope. If nobody's attending the chat session at the time, try to leave your email address or your account number in the chat so we can get back to you. All of this is available in the mobile apps as well. They have the same look and feel. We also have a desktop Windows platform if you don't want to see all of the charting and the pictures. If you just want to see numbers and a more kind of old school platform, we have a Windows platform, but I highly recommend that you use this one. We also, there's one other feature over here. If you go to the, click the information button, here you can see information about the daily change, high, low, and close. So here's the trading, and here's market information. You can see implied volatility curves. Where was the implied volatility today is in green, in blue. Where was it a week ago in green? Where was it a month ago in red? And what was realized volatility? So a lot more information for you to see, and same thing, of course, in the mobile app. I think I've covered most of what I want to cover today. Thank you for joining us. We should have another release and update of the WebTrader to improve this, the decimal places. We're supposed to have 4 or 5 decimal places down here, not 3. It's a little bug. I'm asking if there are daily option expirations. Yes, we have daily option expirations for the strategies and for individual options for everything. Options always expire at 10 a.m. New York time. That is the standard options expiration for most markets. All of our options trade at 10 a.m., expire at 10 a.m. New York time. So an overnight option expires tomorrow morning, 10 a.m. New York time, which is a little less than, it's 1 day, it's 24 hours and 10 minutes from right now. All right, thanks everybody. Thanks for joining us. We'll have another webinar in about 2 weeks. In the meantime, definitely please use the platform, try the platform, mobile, whatever you like. Same account, you can use it in mobile or in desktop. Give us some feedback, give us a nice review if you like in the app stores, and we'll see you soon. One last thing I should have said at the beginning, nothing that we said today should be understood as a recommendation or advice on trading. We are an execution only venue. You can buy and sell to your heart's content, but we are not regulated to give advice. We're here to give you access and to give you tools to trade trade responsibly, trade carefully, and have a great day. Thank you.